Good morning and welcome to the Killik & Co market update. This week we've had the latest inflation data from the US and the number came in at 4.9%, slightly below expectations. This means it's more likely that the Federal Reserve will be able to pause on its continued interest rate hikes. And this should be good news for equity markets. After this US inflation data was published, we saw US equity indices moving higher, with a particularly strong performance from the technology sector. However, the falling inflation that we've seen in the US over the last few months has caused the dollar to weaken. If inflation is falling, then interest rates don't need to be so high. And if interest rates don't need to be so high, then that makes holding dollars less attractive. Therefore, people have moved out of dollars, and that has caused the currency to weaken. Here's the pound versus the dollar over the last 10 years. Back in autumn 2022, following the mini budget, £1 would only buy $1.03. The dollar was strong and the pound was weak. This week, £1 can buy $1.26. The pound has strengthened and the dollar has weakened. If you value your portfolio in sterling and you have dollar investments, you will have noticed a decline in the value of those investments in sterling terms because of this currency movement. However, if you're holding sterling cash and you've been waiting to buy dollar stocks, you'll be better off buying them now in currency terms than you would have been buying them last autumn. Concern has been growing this week about the US national debt ceiling. In the US, there's a law that states the maximum amount that the government is allowed to borrow. Currently, that's around $31.4 trillion. If the government wants to borrow more, a new law has to be passed in order to raise that debt ceiling. This has been done many times in the past, but this time, the Democrats and Republicans seem to be struggling to agree on the terms for raising the debt ceiling. Essentially, the Republicans want the Democrats to agree to massive spending cuts before they will give their consent for that debt ceiling to be raised. Here's US national debt over the last 10 years. You can see it's been rising steadily with a jump in 2020 due to the COVID support package. As things stand, the US government would run out of money by early June if the cap isn't raised. Government employees wouldn't be paid, social security benefits wouldn't be paid, and if things got really bad, the US would default on its debt, and that would destroy confidence in its economy and make people reluctant to lend to it. It's unlikely that an agreement won't be reached before the deadline, but nevertheless, investors are still feeling a bit uncomfortable about the fact that we're so close to the deadline and an agreement still has not been reached. And finally this week, we've had the latest interest rate decision from the Bank of England, along with the publication of their quarterly monetary policy report. The interest rate has been raised to 4.5%. Here's a chart showing the rate since 2002, and you can see we're now pretty close to where we were in the years before the financial crisis. The quarterly report contains some data on where markets are expecting interest rates to go from here. US rates are thought to be pretty close to their peak, whereas UK rates are expected to rise to 4.85% in September before starting to come down again. The bank is still expecting inflation in the UK to start falling heavily from now. Even though inflation remains over 10% at the moment, the bank expects it to be down close to the target of 2% by the end of 2024. Moving on to have a look at next week, it's looking a bit quieter on the calendar as we're moving towards the end of corporate reporting season, but we're expecting results from Vodafone, TJX and Experian. That's it from us. Enjoy the weekend and we'll see you next Friday.